Michael Pond, co-head of U.S. investment rate strategy over at Barclays Capital. Michael, jump in here and try to explain what's happening right now in the U.S. Treasury market.
Look, as you mentioned, there has been a sense of panic in the markets over the past week. Today, cooler heads are prevailing. We got some stronger than expected data this morning on initial jobless claims. And as Lisa just mentioned, we have a bond auction, a 30-year auction coming up 1 o'clock, and the market is backing yields up for investors to be able to absorb that. Still low yields historically, but at least they're higher than they were at the panic lows of Wednesday.
Let me ask you, Michael, at some point, right, this is not anymore about a relative value question. People are not buying treasuries because they look good to other asset classes, purely about safety. Once we actually see the markets bottom out or a sense of calm, would you expect a massive unwind of these trades? Would you expect money to come pouring out of the Treasury market and into other riskier asset classes?
Well, it's funny, at the beginning of the week, we were getting questions of whether Treasuries would sell off massively because of the U.S. downgrade. We're no longer getting those questions because investors are coming to the Treasury market because it is is one of the largest, most liquid market in the world. We do expect that rates will back up. Because the moves that we've seen have been panic-related moves. Investors have been covering shorts and just flocking into U.S. Treasuries because of safety, just running away from other asset classes. We do expect Treasury yields will back up as the calm that seems to be back in the market continues over the next couple months. But that's not to say that we couldn't go below 2% before rates back up again.
Hey, Michael, what are you telling your clients to do today if they are sitting in cash?
Our basic view over the past couple months, because of the uncertainty and volatility out there, has been that we think investors should position for a steeper curve. We had looked for a steeper 5s 30s curve. Now we're looking at a steeper 10s 30s curve. We continue to hold that view rather than try to take a big bet on where yields will move. They moved down. Now we think they will move up. But the better conviction trade is for steepeners. Investors have also become more concerned about longer-term inflation now that the Fed is potentially adding additional stimulus, despite the fact that core CPI is up at a 2.5% rate this year. They're adding stimulus. So they're almost ignoring their inflation mandate because of the growth mandate. That puts inflation risk back on the table, at least from a longer-term perspective.
Michael, I know you want to move away from giving us a target, but how much would you expect a steepening between, say, the long bond and the 2-year?
And only 30 seconds, Michael.
Well, the 2-year isn't going anywhere for quite a while. It's pegged below 20 basis points because of what the Fed said the other day on keeping short rates low for till mid-2013. The long bond, though, can sell off a good 30, 40 basis points just over the next couple of months.
All right,
okay, Michael Pond, Barclays Capital.